we've looked at some very powerful financial institutions and players, the powerful entities that dominate the global machinery, that control money, influence global affairs, and slowly, quietly, dominate over the world. So here's another one of those such entities, one that seem like common knowledge within the financial industry, yet are virtually unheard of by the rest of the population. These are the enormous firms that decide what money goes where, who gets investment capital and who doesn't, and sets the economic and market expectations that nearly all of the large pools of capital work under. These are the institutional investment consultants, and with a name like that, they seem like they should be very boring. Yet hidden just out of view is an industry that gatekeeps the majority of global capital, and may in turn perhaps be said to be the most powerful investors in the world. Globally, this rather small industry is on top of tens of trillions of dollars, overseeing the majority of public pension plans, sovereign plans, and endowments. Total global assets under advisement is around $41 trillion, with a staggering share concentrated in the top firms like Mercer, Aon, Willis Towers Watson, Cambridge Associates, NEPC, and Makita, with a single firm advising multiple trillions. NEPC with nearly $2 trillion, Aon with around $4 trillion. So let's take a closer look. In the world of post-war finance, in the 1950s and 60s, the asset allocations for large investment plans were generally handled by brokers. This wasn't particularly difficult, as most large investment funds, like pensions and university endowments, were made up of stocks and bonds. Traditionally, this was the 60-40 allocation, it being extremely common for a large fund to hold 60% stocks and 40% bonds. Back in these days, with either individual securities held outright, or through large mutual funds. They had high fees, they were bulky, and they were simple. The most common deviations off of this model would usually include real estate, with university endowments in particular frequently holding real estate as a major allocation. But aside from little deviations here and there, largely this was it. The large pools of capital generally had something like a 60-40 split of stocks and bonds. In 1969, Cowen Associates would be founded. They would pioneer formal performance measurement. If you have something like a large pension plan, you hold multiple investment positions. Say your stock allocation includes a number of different individual stocks that your fund owns, yet all the while you are getting constant contributions, and you are being made to constantly pay out to the workers on your plan. At a certain point, it gets difficult to say exactly how well you're doing. And so as the complexity of investment plans increased, a new industry would open up for professionals to monitor how the funds were doing, and as well in turn, new metrics to analyze investment risk would be pioneered. In 1973, a group of Harvard graduates would form Cambridge Associates. The goal? To advise endowments on structural asset management. Something was beginning to emerge at this point. Many of the larger and more sophisticated funds were beginning to look beyond the 60-40 stock-bond split. New, more sophisticated investment managers were beginning to emerge, with early forms of hedge funds beginning to attract interest. And so increasingly there was a need for professionals who understood this landscape. Yet largely this was all quite niche. The large pools of capital, the gigantic funds that moved markets, really weren't that sophisticated. Largely, it was still pretty straightforward. And really, if you aren't trading frequently, only maybe adjusting your allocation once every few months, why would you need particularly sophisticated help? Why would you even need a permanent staff? This would all change very suddenly the following year, in 1974. That year, the Employee Retirement Income Security Act would be passed. This act would legally establish fiduciary duty for pension plan sponsors. Now there were all sorts of new requirements and liabilities for those overseeing large institutional funds, particularly defined benefit pension plans. And so this caused some alarm. All of a sudden, if they made a dumb investment decision, they would need to make sure it was justified, or else risk running afoul of ERISA. The solution presented itself self-evidently. These budding consulting firms would step forward, presenting themselves as qualified professionals. The argument was obvious. If you were tasked with running a pension plan, and you were terrified of running afoul of this legislation, then bringing in one of these outside professionals could almost entirely shield you. For if something went wrong in your plan, but it went wrong in the same way it went for everyone else using the gold standard experts, then you had done your best. You had maintained your fiduciary duty. And so the industry would grow. In 1978, the consulting firm Makita would be formed, with New England Pension Consultants in 1986. Around the same time, institutional allocation was beginning to become more sophisticated. In 1985, David Swensen had taken over the Yale University Endowment. Realizing the long-term nature of this pool of capital, he reasoned that the endowment could take on more risk, investing in very long-term investments, as the endowment would never need to get at too much of its cash at once. At the same time, there was a boom in alternative strategies, such as the expansion of hedge funds, the pioneering of levered buyout, and a growth in venture capital. And so under this new Yale model, funds that could think long-term began to allocate much more of their capital to them. And so in turn, the part-time trustees of many of these institutional portfolios were just no longer equipped to understand the landscape. Stocks and bonds had been one thing, but how would someone like a firefighter or a teacher make sense of different levered buyout managers, quantitative hedge fund managers, or venture capital and cutting-edge technologies? And so firms like Makita and NEPC would enter, with the industry growing rapidly. Over the following decades, they would copy Swensen's Yale model to increasingly more institutional portfolios. The much more aggressive, illiquid, long-term approach was increasingly becoming standard, all while modern portfolio theory became philosophically dominant. The belief that asset allocation should maximize return relative to volatility, attempting to create the most efficient allocation. This would all move along quite well. The industry was growing quite large, and though they weren't charging the high fees of hedge funds or private equity managers with such staggering amounts of capital they were advising, those smaller fees would add up to enormous revenues. However, as the 21st century began, the dot-com crash would reveal a structural weakness. The crash would reveal that generic equity allocations were insufficient. The consultants would shift their clients heavily to alternatives, hedge funds, and market-neutral strategies, attempting to close the funding gaps for corporate and public pension plans. Increasingly, this heavy allocation to hedge funds and private equity was now being presented to pensions, and so this proliferation of the Yale model that had been underway would be ramped way up, becoming the dominant standard for nearly everyone. Many have seen the enormous growth in the private equity industry, and thought about just how it got so large so fast. One of the most fundamental driving forces in this were that nearly all of the big investment pools were using these same consultants who believed in the same model. There were only a few experts, and they were all saying, buy private equity, buy hedge funds, buy illiquid alternatives. The 2008 crisis would reveal another one of these structural weaknesses. The sheer scale and breadth of the crisis would demonstrate that part-time investment committees could not move fast enough in highly volatile scenarios or in crises. And so once again, these firms would step in with a solution. They would present OCIO, Outsourced Chief Investment Officer, instead of simply relying on them for advice, which in reality was almost always taken. Why not just let them manage the money directly? And so too, this would grow. Now these enormous gatekeepers of capital had become investment managers themselves, beginning to take on first billions, then tens of billions, then hundreds of billions, then trillions of dollars. All the while they would present private equity as the obvious solution, funneling many billions each year into the industry, all acting in lockstep, building up this enormous sector. At the same time, the investment consultant industry was undergoing its own private market actions. Particularly following 2019, there would be extreme consolidation within the industry. Makita and PCA would merge, Mercer would acquire Pavilion, and Hightower acquire NEPC. Yet there was something more beneath the surface. This wasn't just a big industry consolidating. Increasingly, private equity firms themselves were noticing this business, and realizing just how marvelous an opportunity it was. These firms presented very reliable, comfortable cash flows. Yet more than that, imagine that you're a large private equity manager, one with enough money to buy a company like one of these consultants, and you know that these consultants are the ones who tell the big money whether or not to invest in you. Well, that seems like an opportunity. And so the private equity circle spiraled. Private equity firms would buy investment consultants, and investment consultants would direct the capital of their clients into private equity funds. But don't worry, I'm sure that there's nothing untoward. That never happens in finance. That's where the honest people go to work, famously. So just how big a role has this industry played in global finance? Well, in the 1980s, they brought the Yale model to all of institutional capital. Without this move, the hedge fund, private equity, private credit, and venture capital industries would very likely be quite unremarkable today, because they directed so much capital. Once one of these big consultants, like Makita, NEPC, Cambridge Associates, Mercer, or Callan, came out with, hey, pension funds should have 15% in private equity. In very short order, almost every pension plan in the country would do that. The really troubling thing isn't the herding of capital. This certainly can and does lead to inefficiencies, but the really troubling thing is just how much of a hive mind this industry is. When you go and meet with your expert consultant, you expect that you are talking to some brilliant expert who is giving you insights, but really in this industry, you're meeting with a representative for a set of industry conclusions. And that's not laziness, that's intentional. You go to one of these consultants for their standardized, firm-wide advice. You should be indifferent between speaking with one of their consultants and another one. But what's more troubling is that the conclusions are nearly identical across all of these firms. Go to Makita, go to NEPC, go to Cambridge Associates. It doesn't really matter. You're going to be told roughly the same thing, which for the past several decades was, you don't have enough private equity. But this doesn't just apply on the big asset class level. What makes these firms so powerful, and ones that nearly every investment firm obsesses over getting friendly with, is that if you want to touch any of those big pools of capital, they have to recommend you. And while there will be some deviation, maybe some new fund that Cambridge Associates knows and will recommend while the others don't, or there's some fund that the others like, but for some reason Makita really doesn't like it, that's the vast minority. They usually pretty universally agree, and if a manager doesn't have a buy or recommend rating from Mercer, NEPC, Makita, or Cambridge Associates, then they're effectively locked out of 80% of all institutional capital. Around 80% of institutional RFPs require one of these consultants to sign off for a manager to even pitch themselves. It's not just that these consultants are trusted, and so you need them on your side. It's for an investment manager to even talk to the money. They must be approved. That's the sheer grip these firms have. They can lock you out of 80% of all of the big money. And this would be fine if it was careful and considered, but because this industry was built on blame mitigation, going back to the ERISA legislation, the entire ethos of this business as a whole is that it's better to fail conventionally than succeed unconventionally. The entire raison d'etre is nobody got fired buying IBM. And so if there's something that's novel, innovative, and correct that goes against consensus wisdom, someone who sees something that must be understood, someone who sees a truth that others are ignoring, largely, this industry will act as a means of gatekeeping it out. Why? Because if it goes against the consensus wisdom and ends up being wrong, then that's an unacceptable failure. However, if the consensus wisdom fails and everyone goes down together, then, well, you did the same as everyone else, it's fine. But what about that upside? What about that chance that the consensus wisdom is wrong? Well, one, they consider it far too much a risk. But two, for them it really isn't upside. For them it's still, hey, that was a bit much of a risk. You're lucky it worked out. That's really how they think. Maybe even more fundamentally, this industry is maintain the status quo at all costs and never question. But it isn't just risk aversion that's causing this. As this industry got so large, a set of smaller industries grew up around it. This includes software businesses, making things like reporting platforms, accounting software, things of that nature. Yet as well, the investment manager research teams at nearly all of these companies use near-identical software for screening and data retention. In particular, eVestment. They use the same risk and performance metrics, a 3 to 5 year track record, some sort of rating on team stability, the minimum AUM threshold, and strict tracking errors. And so the sheer level of this standardization has created a systemic bottleneck, directing tens of billions of dollars simultaneously into a small group of identical managers. Because just one of these consultants can have hundreds or thousands of enormous pools of capital listening to them and doing whatever they say. This means that when a consultant changes its macro thesis, thousands of institutional investors move all at once. Institutional money all moves in the same place at the same time, and ignores the same things at the same time. And usually, this is the entire industry at once. It's really quite rare for these different consultants to disagree with each other in any fundamental way. And so particularly with the rise of OCIO, and the very large investment from private equity, these large movements of capital have had striking ramifications. As the OCIO sub-industry has risen, many of these firms have begun to create their own proprietary pooled funds. This, in turn, has compounded the issue of the over-allocation to private equity, really making the industry a behemoth. At its core, this is really a party line problem. A really big problem with capital markets today is that they're very unthinking. Back in the days when large pools of capital actually went out and bought stocks, this at the very least required them to look at the stocks themselves, or they would be allocating to mutual fund managers who would do that on their behalf. Yet this is a very different world right now. The bulk of public equity dollars track indexes, and whenever there's some fundamental macro thesis change, the institutional money moves all at once. And so if there's some fundamentally flawed assumption on the part of these investment consultant teams who exist within the firms, distributing a core thesis to all of their individual consultants, this is a very small team setting the macro thesis for potentially trillions of dollars. Trillions of dollars all at once. So you can point to investment managers and point out the problems of over-indexing, point out the problems of herding behavior, problems of managers being too risk-averse. But something much larger in scale and much more fundamental is that a small research team at one of these consulting firms can instantaneously set the macro thesis for trillions of dollars all at once. And since the industry really doesn't like to deviate that much, usually they'll all adopt pretty similar lines in short order. And so there is a party line within capital markets. Once the consultants say it is so, functionally it is so, until something so fundamentally pops up and whacks them in the face. So what are these models? How are they making these assumptions? Well, at the core, all investment consultants operate under Harry Markowitz's modern portfolio theory. This requires estimations of the correlations between asset classes. An immediate problem presented here is that you can either use historic correlations or create your own expectations. Similarly, Another input is volatility. Again, either using historic numbers or parameterizing your own. Yet how do you go about doing this? The conventional wisdom is to use historic numbers. If you're looking over long, multi-decade time horizons, then most likely what has happened in the past will largely be what happens in the future. Yet this is tragically wrong. Take, for example, the credit bull run from the 1980s to, well, just a few years ago. That is a deep secular change that never happened before, and now we have exited. What do you do when the operating monetary model changes? What would you do with your pre-Federal Reserve assumptions after the advent of the Federal Reserve? At the core, these very risk-averse firms all operate assuming that things will largely be how they have been. And so there's this very deep normalcy bias that permeates nearly all large capital in the United States and Western Europe. Using this modern portfolio theory model, with those inputs and 10 to 20-year return assumptions, the standard approach is to run a mean variance optimization model, where the goal is to maximize the expected Sharpe ratio. Considering already the problems inherent in making assumptions for the model, why exactly would you try to maximize a Sharpe ratio over 10 to 20 years? There's a very heavy reliance on standard deviation as risk inherent in mean variance optimization. This is a problem that keeps coming up in financial thought. How good is volatility, standard deviation, as a proxy for risk? And that probably depends on your time horizon, and that probably depends on what your needs are. So there's a real problem with a one-size-fits-all approach. And additionally, in turn, such a heavy focus on volatility has made private market investments look a whole lot better than they are. I've gone into more depth on this in the private equity and private credit videos, but the fundamental crux of the problem is that as these private market funds are valued quarterly and are therefore not subject to day-to-day volatility, they look a whole lot less volatile than they are. So if you were to take the return of a private equity fund and map it against the standard deviation, you would get some astronomically inflated Sharpe ratio. So you can't really use that for mean variance optimization. And there really is a private equity problem here. So much money has been directed into these opaque funds that it's allowed valuations to remain elevated, and for funds and investments to extend far beyond the actual business realities, that it's hard to see it as anything other than artificial malinvestment. And so now nearly all of the large institutional funds that so many people rely on, vital pools like healthcare funds and pension funds, are extremely susceptible to anything going wrong in private markets. Just take a look at the private credit redemption requests. That is now for 2 quarters routinely bumped up against crisis. Any real shock to credit could cause a really disastrous cascade, and it wasn't necessary for it to be like that. But simultaneously, in lockstep, all of these large funds were being assured that these investments were safe and that they should put increasingly larger amounts of capital into them. These funds were all assured that there was an illiquidity premium that they could receive, and so if they had longer time horizons, then they should tilt heavily to private markets. But since there's this lag in valuations, this artificial low volatility, which allowed these plans to appear to be performing better in times of crisis, is this illiquidity really something that these investors are still demanding higher returns for? Is it something that they need compensation for? Because in many ways for these plans, having that illiquidity and opacity really benefits them. And why would you get compensation for something that benefits you? And so the fundamental core argument of the illiquidity premium may be evaporating away. Looking closer at performance analysis and reporting for a moment, a very large component of these businesses is their reporting and analytics. Performance analysis is often something that people don't think very much about, because if done well, it should be seamless, simply appearing as though it's naturally always there. But it can actually be quite tricky, and there are some unresolved issues within the practice. A very big concern for these sorts of investors is benchmarking. As industry practice, all of the individual managers that they allocate to will be pegged against a benchmark. For example, comparing the performance of your large cap fund to the S&P 500, or perhaps your broad bond fund to the Bloomberg aggregate. But there's a really tricky problem when it comes to these alternatives. How exactly should you benchmark private equity or a hedge fund? The dominant solution for private markets has been broad private market indices, particularly those produced by Cambridge Associates. But since this industry is lagged, opaque, and it's really hard to compare one manager to another, it can be quite difficult to actually say what your fund should be benchmarked against. If you have a portfolio of large cap American stocks, then it's fairly reasonable to compare it to the Russell 1000 or S&P 500. But how do you compare a single private equity fund with the idiosyncrasies of that particular manager, operating in particular business segments, with particular strategies, particular finance, and its own unique set of circumstances? Well, the solution of compare it against the Cambridge Associates private equity, for example, is just so low resolution. In turn, these benchmarks are rolled into allocation and policy benchmarks. Benchmarks made up of the benchmarks within a portfolio, designed to either represent what, in theory, a portfolio following its policy exactly would look like, or compared to a weighted average of all of the individual benchmarks of the individual investments, based on what the actual allocations in the portfolio are. But once you start having large allocations to things like private equity, then your top-level benchmarks, that are the relative metrics that you are comparing your performance to, start becoming quite skewed by these very low-resolution private equity benchmarks. And so there's a problem for the entire industry. If you can't really benchmark how private equity should be performing, then at the top line when looking at the whole portfolio, how can you even really compare how those consulting firms are doing? What are you really comparing the performance of the portfolio against, if so much of it is low resolution and perhaps irrelevant? At a high level, maybe the real problem with this industry is that it creates single points of failure. I don't mean to suggest that this is some sort of shadowy and nefarious controller of capital, or some sort of manipulative force that has hijacked global capital, and we certainly have plenty of those. Generally, these are well-meaning people, following the traditional and consensus wisdom, just trying to help non-professional investors in impossible positions. Perhaps you might even say that, at least in theory, these are some of the more honorable good guys in finance, offering advice or management for investors like firefighters' pensions, healthcare plans, and well-meaning people put in the impossible position of managing hundreds of millions or billions of dollars that others rely on. But as we've seen throughout history, the lack of diversion of ideas, the herding of investors, and the unchallenged reliance on consensus wisdom can become really quite disastrous. And with these firms acting as fundamental gatekeepers of all the big money, it's really quite important that they don't guide capital astray. Perhaps one of the biggest problems and most fundamental points of failure is just how dependent on normalcy bias they are. The models they use and the advice they give all have these inherent normalcy biases and assumptions of mean reversion. The capital market assumptions that go into their models, like mean variance optimization, typically use historical long-run averages for assumptions of inflation or interest rates. Yet the problem this represents is that they are inherently always backward-looking. And if these are supposed to be the experts who can guide big capital through tricky and complex situations, then looking backward is really not that useful. So what do they do when they are faced with a fundamentally different economic or financial regime? What do they do when the macro changes fundamentally? For example, taking a look at the incoming Fed chair. If we really do begin to move against the old, embedded, and entrenched Keynesian assumptions that have dominated fiscal and monetary policy for nearly the past century, then those assumptions of inflation and interest rates go right out the window. If historically wages rising too fast, or output rising too quickly, would lead to an increase in Fed target rate, and in turn the Keynesian contra-cyclical mechanism, then what happens when that stops? Or how about last year in 2025? The fundamental structural change to gold and silver. Largely, these firms weren't prepared for it, because those mechanisms of fundamental changes to the LBMA and LME, investors demanding delivery all at once, and a fundamentally new treasury regime just aren't there. So particularly now, as we're going into a time of very deep fundamental change in the global monetary system and global trade, entrusting the majority of the most important capital in the nation to a backward-looking hive mind who base their assumptions on normalcy bias could actually be the most disastrous thing possible. And as well, this reliance on volatility as risk could so easily miss the entire point of these changes. Not only do we have that smoothing effect in private markets, but if you're in a tricky macro environment, and particularly if you're looking over longer-term time horizons, then having the volatility in the meantime be the thing that you're trying to minimize could so easily lead you to really poor investment decisions. For example, the role that gold plays has fundamentally changed, yet if you simply just incorporate the last year's performance into an average, then all you'd really see is elevated volatility, missing the entire point and the role that it could play in the portfolio of the future. And particularly in private markets, thinking of it as a predictable and understood asset class can be much more catastrophic. Generally, investment consultant private market modeling assumes distributions from mature funds will be sufficient to fund capital calls for newer funds, so long as target allocation remains relatively consistent. Yet, as seen in the past couple of years, when IPO and M&A windows freeze, distributions will drop while capital calls accelerate, forcing plans to dump their liquid assets at losses. This is well made much worse by the denominator problem. Assume a pension fund that has a large allocation to both public equity and private equity. In a stock market contraction, public equities will sell off, yet those lagged private market investments that are only marked each quarter will continue to appear flat. Suddenly, the portfolio's allocation to private equity is too high. This overallocation will trigger a halt to new investment when new vintages are actually the cheapest. This creates enormous market inefficiency, as these funds are bound quite strictly to their foundational documents, which include target allocations to different asset classes. Then these sudden appearances of misalignment can force them to take the exact wrong investment decision. Now, in order to address this, some plans allow for the temporary overextension from these targets, or some might hold emergency meetings, attempting to change the policy ranges at short notice. But this is very slow and inefficient. This really doesn't allow them to react in time. And so just as a result of the numbers not even reflecting the real business and economic reality, these funds can be forced to miss the investments that they really should make, and to take investments that they really shouldn't, making a much less efficient market that behaves far more irrationally. A good example of these sudden target misalignments occurred in just the past couple years. IPO and M&A activity froze, all with elevated interest rates. Distributions plunged, while public equities soared. The plans were starved for cash, all while the plans got out of target alignment. By mid-2025, 62% of pensions extended their private equity targets, with, just for example, the California State Teachers Plan, $8.7 billion over target. Institutional plans experienced a synchronized liquidity crunch. Pensions halted their investments to new vintages, sold at highly depressed secondary sales, or increasingly would begin turning to synthetic liquidity vehicles, like continuation vehicles, functionally trading derivative contracts to artificially delay the realizing of losses. And going deeper into the assumption problems, with this backward-looking normalcy bias, the assumptions of how asset classes are correlated are treated far too statically. Just as perhaps a more common example, when inflation shocks drive monetary policy, stock and bond correlations can suddenly flip positive, breaking the correlation models. Now, will this be the same in a post-Keynesian world? Well, perhaps not. Yet navigating these really tricky, nuanced structural changes should be exactly what these experts are for. But instead, they just professionally herd investors to ignore it. The shift from LIBOR to SOFR fundamentally changed the interest rate mechanism, breaking so many of the rate assumptions of history, since very suddenly, actual collateralized American interbank lending was driving rates, and not the liquidity needs of the offshore dollar, allowing the Fed to maintain elevated interest rates for much longer than any of the old consensus wisdom would believe. Just what do we do with a world of Bitcoin? What do we do when gold and silver begin taking on a fundamentally different role? These models look at historic data but don't really ask why, and so they can't incorporate behavioral or psychological changes. The old solutions to old problems very rarely are the new solutions to new problems, and new environments can create opposite reactions. And so, as all of the big money are operating with these deep biases, all while relying on models that can't really handle illiquid private market investments very well. If you were to read the CFA textbooks cover to cover, that's pretty much what you're gonna get. The book. And is by-the-book dogma really what you want to get you through a novel and complex situation? The old consensus wisdom hive mind really is a big problem, and the effects can be really catastrophic. Look at 2022 in the United Kingdom, the sequence of financial crises that led to the end of Liz Truss's premiership. The British pension system had become dependent on highly levered derivatives, following a strategy of liability-driven investment, where the goal is to invest in such a way that the duration of one's assets match the duration of one's liabilities. In theory, constantly have something to match the payments that must be made. In autumn of 2022, Britain's mini-budget would face some sharp opposition at the Treasury, in the City, and at the Bank of England. There would be a sudden non-linear spike in gilt rates. Meanwhile, these highly levered plans had been built by consultants who hadn't modeled a situation like this. The models had assumed normal bond market volatility. There would be billions in pounds in collateral and margin calls. Gilts would be dumped all at once into a cratering market, and so a doom loop had been created, quite seriously threatening British sovereign debt and the survival of its pension system. The British pension system was in such a precarious situation, and because all of the plans were doing the same thing, because they had the same advisors, it just spiraled so suddenly. And it was entirely unnecessary, yet they all operated on those same flawed assumptions. When everyone makes the same mistake together, the fall is so much harder. And so maybe there isn't that much to take away from this video. Maybe there isn't that much to do. If you're an individual investor, perhaps it's worth considering just why the money moves the way it does and why it seems so irrational. Why the capital is all funneled into the same places at the same time. This one isn't a story about heroes nor villains. This one isn't a story about any big schemes, plots, nor any remarkable history. This is perhaps a story of bureaucracy, a story of being slow to change, a story of concentration, a story of dogma, and a story of groupthink. But since there is so much wealth controlled by these institutions, this very small handful of firms with such incredible power, there are certainly players that need to be understood. As the world changes, most likely too will their role in the financial order. Presently, there appears to be a very large push to shift their services to private wealth and family offices, particularly as defined benefit pension plans begin to fade away. And so maybe that's the real core battle in the story. The archetypal conflict worth exploring. The static, slow to move, backward-looking consensus versus vibrant innovation that's willing to push outside the box and stand against the crowd, telling them that they're all wrong. But in a world where people would rather go down with the ship because they did so in the same way as everyone else, rather than taking a chance on succeeding on their own, maybe in the midst of the problems presented, this should be a remarkably uplifting story. For if you can be the one who does stand alone, who is willing to succeed or fail based on his own unique insights, then that's where greatness comes from. The financial system has become such a risk-averse hive mind. It's become so terrified of questioning the status quo. And maybe if you can be the one who can, well, that just means you can rise so much higher in this world. That just means that the one who can stand against the crowd has the opportunity to shine so much brighter. Yes, in a world of consensus and conformity, you will face constant pushback. You will constantly be pushed out. But ultimately, reality has a way of asserting itself, demanding that all look at it whether they want to or not. And when that day comes, the one who is willing to question, the one who is willing to stand alone, certainly he could fail. But he may also be the only one who wins. Chance is risky. Chance is scary. Yet it is also the birth of greatness.